Hey everyone, this is the real EA Justin Williams with Helping Hand Accounting Services. Here trying to give out some more advice. I've been getting a lot of questions recently on real estate investments and how is it taxed, how can they, a couple of loopholes that they can find, what have you. So that's what we're going to talk about today. Well, before we get started, just want to quick announcement as far as for people that's getting in the real estate industry or that's already in the real estate investment industry. Just please protect your assets by getting an LLC for each and every property, for each one individually. If you put all of them in one bucket, if something happened to one of those properties, you may lose them all. Bankruptcy, all kinds of different things. I mean, laziness is not a reason you should lose everything that you've worked so hard for and to obtain. Okay, so I tell my clients just list it as whatever the address is, LLC. I mean, it's really that simple. Okay, as long as it's under LLC, I feel like there's no problem really within it. Okay, all right. So what is a 1031 exchange? A 1031 exchange, as of 2018, only applies to real estate. Before it applied to different artifacts, paintings, and things of that nature, like rare emblems and stuff of that nature. Okay, but now it only applies to any property that is meant for real estate investments. So going forward, for example, let's say that you had a rental property, a single family home. Uh, you wanted a bigger one, so it had to be. So you sold this one for $20, and the one that you purchased has to be from equal or greater value. Okay. Just to really give you some better numbers, I'm gonna go back to the 1940s. Okay, let's say for example, you bought the house in 1940 for $15,000. Okay, you bought a 1,200 square foot single family home, and you rented it out. Let's say for 20 years, you kept fixed. There's repairs over the years, whatever. Okay, so you got tired of the location of it, let's say, and you wanted a better one. Okay, with a better location, may bring in some more money rental as far as renting wise. Okay, so you sell a house for $45,000, and now you have to recognize a $30,000 gain. You bought it for 15, you sold it 45. Okay, if you for a 1031 exchange to work on this, you would have to identify the property that you're trying to buy within 45 days. Okay, 45 days. Don't try to do it on the 46th day. You're messing everything up. Okay. Then you also have to complete the purchase within 180 days. Okay, so hey, I just tell people, hey, this is why you have to have your team. You have to have the your mortgage lender, your real estate agent. You need your attorney or a title company, your accountant, and you need your financial advisor. Make sure that all these things are rolling together. Because if you don't have it rolling together, and somebody dropped the ball and it was 46 days, then it messed everything up. Okay, so I'd rather that not happen. So just get your team together. Okay, so let's say that so instead of recognizing the $30,000 taxable gain based off of the income, you defer it. Okay, you defer it till you sell the new property. So fast forward is 20 years later. Now we're looking at the 1980s. Okay, you tired of this property and you decide to sell it. It's like, hey, it looks good, and you want to get a double now, because you feel like, hey, like the location in New Orleans and everything. I'm saying is the parade is right on the parade route and everything like that. It's like you really like it. Hey, let's invest. Okay, so you sell your property for 90,000, and you purchase that one, let's say, for 110. Okay, $20,000 difference, but still in all, you have to recognize the gain that you made off of it of additional $45,000. So now total you have $75,000 in taxable income that you are deferring because you identified the property in 45 days and you completed the purchase because you have such a wonderful team. Okay, now we're gonna fast forward to year 2000. This double, hey, it's really good, but somebody just showed you this property that they just inherited. They're trying to get rid of it, and it's a sixplex. It got six different apartments in it, and you want to get it. Okay, so now it's like, hey, quickest way to do that. You got your friends, your team already. Excuse me, and you decide you're going to sell the duplex that you had. Now you sell a duplex for 200,000. Okay, you had a big gain. You had a extra $90,000 in gain because you remember it was 20,000 more. But with that being said, now you have $165,000 that still has not been taxed. Okay, no taxes have been applied to this money, this income at all, and we're gonna just defer it again. So now 80 years later, real sick. I mean, we're like 100 years old at this point, and we pass away. Now our kids are all upset with us because the IRS sent them a bill talking about our estate, talking about that the sixplex that we fixed up and everything and was being rented is now valued at $1.2 million. $1.2 million. Like, it really just shot up just because of the location. We didn't know it was that important. We didn't know it was that good. But I mean, the housing market, everything is doing good to us right now. So at this point, they're shaking in their boots because the IRS doesn't tell you that you have to pay taxes on the $1,185,000. Send you the tax bill, the IRS. They'll tell you like, well, hey, we estimated as you owe us $435,650. I don't know about you, but I don't have that type of money just laying around anywhere. And I damn sure don't want to pay the IRS that much money. So that's when you get your team together. They give all that information to the accountant that does taxes. Make sure that your accountant does taxes because some of them don't, okay? And try to make sure that the tax person knows how to do the accounting stuff as well, just to make sure that everything is all in one place. Like myself, I do it all the time. So in this situation, the accountant is going to file a return, basically applying the estate tax exclusion. The estate tax exclusion excludes $12.6 million, okay, from the estate. So that $1.2 million that we was worried about originally, oh, that's out the window. So now you paid $0 in taxes. Your parents paid $0 in taxes on all of those sales of their real estate investment. I mean, you can do it too. You could just start. I'm saying, you starting off at 1.2 million at this point because it's an inherited property. It's now yours. Yeah, I'm just saying, this is like, I mean, this is what a lot of the rich people do. They countlessly take advantage of things like this. I tell people, hey, it's out there. Just a lot of people don't know how to do it, don't know how to apply it, really don't know what it is, even though they hear about it, 1031 exchanges. But if you're interested in the real estate investment businesses, you got questions, just contact me at 504-565-1015 or schedule your consult today at www.hhasla.com. It's easy to grow your business with a helping hand. Justin Williams, Helping Hand Accounting Services. Y'all have a good one.